Hello friends, welcome to my class. This is CA Rakhi Agarwal. Today's topic is related to Ind AS 7, that is more or less similar to AS3. Somewhere there are minor changes are there which we will discuss. In this topic we will generally discuss about the technical aspect, the preparation of cash flow statement, what is the direct method, indirect method, certain definitions and certain discussion we will discuss. So let's start our topic. Before starting this topic, I will just give the intro. Uh, Means what is cash flow? Why cash flow is prepared? Cash flow is what? If we prepare financial statement like balance sheet, if we look at the financial statement like balance sheet, PL account, then it will does not reflect the true picture of the company. If the investor or shareholder look at only the balance sheet and PL, they will not decide what was the actual inflow or actual profit of the company. They will not decide by seeing profit and loss or by seeing the balance sheet that the company is doing very well. No, by seeing cash flow statement, only the people will decide the actual inflow of the company and actual outflow. What was the position of the company? Actual position is decided by preparing cash flow. Important statement which give the correct picture of the cash inflow and outflow of the company. So, and also for the purpose of investors and stakeholders, how they will decide that the company is working very well by seeing, not only by seeing balance sheet and PL, they have to look into the actual inflow or actual outflow of the company, which is decided by seeing only the cash flow. So let's start. What is the definition of cash flow? It's a core financial statement. Cash flow is very important part of the financial statement. It gives a correct picture of the company's inflow and outflow. By seeing cash flow, the company will decide what was the actual inflow and actual outflow. Then it is an important statement which gives correct picture to the investors and stakeholders about the company's position. So by seeing cash flow, the stakeholders and investors will decide whether they will invest on that company, what was the position of the company, they will decide accordingly. Not only by seeing balance sheet and PL, they will also need to see the cash flow, because suppose there is if you profit in PL, you will earn profit by selling the property of the company. So that is, you are not earning by operating that by running the business, you are earning due to selling the property of the company, so your profit is very high. But by seeing cash flow, you will see from where the profit is coming, from operating activities or for financing activities or for investing activities. So for that purpose, cash flow is important. So this is explained by example. Suppose during I am taking the COVID scenario, that is very good example for seeing the actual cash flow statement of any company, because that time no work is going on, all operations is shut down, all business is closed. So I am taking that example. Suppose during COVID scenario, when all the business has shut down and no operation is going on, still that time some of the companies showing profit in their profit and loss. How? That time the work is totally shut down, the business is totally means closed. There is no operation going on at that time. That time some of the companies showing profit, showing their PL at profit. How? They are showing like food industries. That time food industries are working very well. Aviation industries are not working. Still they are showing in their PL that they are profitable organization. How? Like food industries, we understand people are purchasing lots of food, and that's why food industries are running well. So they will show their PL at profitable. But aviation industries, how they are showing that their organization is running at a profitable. I'm taking the example of HUL. HUL, in HUL cash flow statement, in HUL, if you take the example of HUL cash flow statement, which they had prepared during COVID scenario, their cash flow showing from operating activity is positive. The cash flow showing from investing activity is negative, and from financing activity is negative. It means their operation is well. Actual, the operation is actually well. Positive means they are doing work. Their operation means are good. Means their income from operating activity is positive. Operating their activity, they are earning income, and that they are investing to the investing activity, and also they are paying some repayments of loans what they had taken. So they are paying their repayments of loan. So that was the position of HUL at the time of COVID scenario. So it's a good position. You are earning from operating activity and you are investing somewhere, and you are also repaying loan. That is really a actual profit. You are not diverting that. You are not selling asset of the company, or you are not taking loan and then investing in your activities, operating activities. This is the actual profit which you are earning by operation, by doing operation, and then investing, and then you are investing also, and you are also repaying the loans. So that is really working very well and during the COVID scenario. And take another example of SpiceJet. SpiceJet at that time, all the traveling and all the aviation industries are shut down, all are closed. So the that time operating activity is totally nil of the aviation industry. But at the same time, the profit showing in both the organization is profitable. In PL, both the organization is showing that their profit are very good. Yeah, in actual we are understanding that they are operating very well. That's why their profit is good. But SpiceJet operating activity is negative. How its profit is positive? How its profit is showing such a good? If the investor only look at the PL, by seeing PL, they will not decide the actual profit of the company, actual position of the company. The profit is also earned by selling the asset, not by operating activities. So the cash flow from operating activity of SpiceJet is negative, and from cash flow from investing activity is positive, and cash flow from financing activity is positive. It means that operating activity is nothing. Means SpiceJet is totally closed. SpiceJet is how its investing activity is positive. Sold some of the assets of the company and then earn income in order to pay out its company's expense. Some of the important assets the SpiceJet has sold, and then he had paid out to run its business by taking loan. I think that's why the financing activity is also showing positive. SpiceJet is taken some loan in order to run its business, in order to pay out its expense, its employees salary, its maintenance cost of the. So that's why this is the position of this budget. By seeing only the financial statement like PL, you will not decide, investor will not decide the actual position of the company. That's why the cash flow is important. What is the purpose of the cash flow? Cash flow's purpose is to check true cash inflow and outflow of the company. What was the actual cash inflow? Quality of profit of the company. What quality of profit the company is earning. By quality means this is the actual profit by operating income, by operation, or for investing by selling its properties, or by taking loan, then they are earning profit. That is not a good quality of profit. By operation, if they are earning, that is the quality of profit the company is earning. To see whether the sale which has made during the year has realized or not, means actual, means you are doing immense sale, means your sale target is very high, but still you are not able to realize that sale during that year. That is also not good. Sale is important, but realization is also important. So to see whether the sales which are made during the year has realized, merely having profit is not important. The profit is actually realized into cash or not is important, which is done by statement of cash, which we will see by seeing by preparing cash flow. Means you are seeing by that turnover is about 50 crores or 60 crores, but in actual you had not means actually you had not you had made the sale during the year, but realization is not done. By seeing cash flow, we will check that the realization is done or not. We had made the sale, but we had not realized the money. That is the purpose of the cash flow, to see whether the realization is done or not. Now, type of cash flow. There are three types, that is cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. Cash flow from operating activity means activity conducted on day-to-day business, like we what operation is going on day-to-day business, whatever the activity is going on, and from that we are generating the cash. That is the cash flow from operating activity. Activity which are not investing and financial, that activity are operating activity. Anything which is ancillary or related to business activity is operating cash flow. Means the thing which we generate, the cash flow which we generate or which is related to or ancillary to business activity is operating cash flow. So this is the operating cash flow, means activities conducted on day basis, activity which are not investing or financing in nature, activity which is ancillary or related to business activity is operating cash flow. Now cash flow from investing activity. If we acquire or dispose any non-current asset or investment, that is the activity from, suppose, acquisition of fixed assets, sale of fixed assets, acquisition of investments, sale of investments. This kind of activity is covered under cash flow investing activity. This kind of activities covered under cash flow from investing activities, other than investment recognized as cash and cash equivalent. Means some of the investment which we do for less than 3 months or for 3 months, that investment is cash and cash equivalents. Other than that, all investment, all non-current assets or investments which we made or dispose of is showing under cash flow from investing activity. Any dividend received from investment, any interest received, all are covering under investing activities. Now cash flow from financing activities, which affects the capital structure of the entity. Any activity which affects the capital structure of the entity. How it affect the capital structure? For example, if we take loan, then it's a financing activity. If we repay that loan, that is also a financing activity. Interest paid on that loan taken, that is also financing activity. Then any dividend paid by the company is also a financing activity. If any bonds or government, if any preference shares issued by the company, then it is also financing activity. All these are the financing activity which affects the capital structure of the entity. Now come method of preparing statement of cash flow. How we will prepare statement of cash flow? What are the methods? There are two methods, that is direct method and indirect method. Nowadays, means Lord SEBI has mandate that every listed company used to follow indirect method. No one is preparing direct method. Some of the companies are preparing, but more or less most of the companies are preparing indirect method. And Ind AS 7 is also saying that please prepare your cash flows by following indirect method. So direct method is not so important, but still we are discussing on that. There are two methods, that is it's upon the company which method they will decide, but in some of the companies it's mandate that they will follow indirect method by SEBI, or Ind AS 7 also saying the same. Direct method means vertical summary of cash flow or cash or bank of the entity. Means they are making a summary in a vertical manner, which is saying as a top-down approach. It is also known as a top-down approach. Like how we are saying it, a top-down approach, because in the PL, the preparation of PL, we are taking in the same way that in PL we are seeing that revenue from operation, then expenses, then cost of goods sold, then whatever the format of the PL, in the same way we are preparing the direct method. That's why it is saying that it's a top down approach. We are taking from the top. That means look at your profit and loss statement in which revenue from operation, how much it is realized, check. Cost of goods sold, how much is that of the paid, means how much the from revenue from operation. By seeing the profit and loss, we will check the revenue operation, how much it is realized, that is received from customers. Cost of goods sold, how much it is paid, that is payment to the suppliers. And from expense, we will find out what is paid out, what expenses is paid out for operating expense, that is payment for operating expenses. And any tax paid during the year, we will do less, that is received from customer, less payment to supplier, less payment for operating activity expenses, then tax paid, then it's come the cash flow from direct method. By so it is a start with top and end at bottom. That's why we call it top down approach. It's actual tagging of cash. It is actually tagged of cash bank account with cash flow statement. So this is the direct method. Now comes the second method, that is indirect method. SEBI or Lord 2015 with effects from 01/12/2015 mandate listed companies to prepare cash flow by following indirect method, and also prescribed under Ind AS 7. The same is prescribed under Ind AS 7, and also the SEBI mandate all the listed companies to prepare its cash flow by following indirect method. So they will not prepare their cash flow by direct method. They will it's mandate by the SEBI and Ind AS 7 that they will prepare their cash flow by following indirect method. So indirect method is a bottom up approach. Why it is saying bottom up? Because we are taking we will start our cash flow by taking the PL, by seeing the PL from the bottom. Like we are taking the net profit after tax. That's why it's then we will come by then we will take any non-cash items, and then we will add and less accordingly. So we are taking, that's why it is saying bottom up approach. Means the company will start their cash flows from down and they will move up. That's why. So how the indirect method is prepared by taking net profit after tax, then add back the taxes, then net profit before tax. Why we are adding the taxes? Because the taxes which is paid, which we will take later on, we will reduce from whatever the activity. If the taxes is paid related to, suppose capital gain, that is the investing, that tax is related to investing activity. For any taxes paid relating to operation of the business, that taxes is related to operating activity, so we will reduce accordingly. But at the same time, at that time, our profit after tax, we will add back the tax, and then we will find out the net profit before tax, or we directly take net profit before tax also. Then we will add non-cash item. Why we are removing the non-cash item? Because depreciation is a non-cash item, which is, it is a kind of expense which we are showing in the PL. So which that expenses is reducing the actual cash flow. If we will directly take the PL, then that is not reflecting the actual cash flow. That's why we are add back, because we are reducing that depreciation expenses which reduce the profit of the company. That's why we are add back, because that is non-cash item. Any impairment made, that is also a non-cash item. That's why we are adding back to the cash flow, because that is not a cash flow item, and which reduce the profit of the company, which is not showing the actual cash, we are add back. So we are adding back it non-cash items. Then we will make some adjustment and add less, like item considered under other heads. Like other head means whatever the item considered in the financing activity, we will take it there. Whatever the item considered in the investing activities, we will take it there. So from operating activities, we will remove that activity. Suppose any profit which we made on the sale of the fixed asset. So that is the profit which we have to reduce from here and show it in the investing activity. That is not an operating activity. If we sell the asset or make profit from that, that is not a operating activity. No? That is from investing activity. So we will reduce here that profit and take it there. And if any loss, we will add back here and take it there. Any interest expense we will made, any interest income we will make, dividend paid or received, whatever we will make the adjustment and take to the respective heads. Then working capital adjustment means trade receivable. Means in last year and in the current year, what is the difference? We will take it here. Suppose in last year, the trade receivable will be 10,000. And in this year, the trade receivable will be 8,000. Means there is a decrease in debtors. Decrease in debtors means you have to get that cash, means the cash inflow had came, because in that time in last year there is a debtor 10,000 and this year the debtor is 8,000, means you get the cash flow, your debtors reduce, so you will make the adjustment here. If there is a decrease or increase in trade means creditor increase, means you had purchased, so difference is there which we will adjust here. All increase and decrease in current assets, inventories, we will make the working capital adjustment, which is also known as operating adjustment. Then all this, after doing all this adjustment, cash flow from operating activity comes. Then cash flow from investing activity, like whatever we make the profit or sale of from, whether we make the profit from sale of the fixed asset or loss from sale of the fixed asset or investment, that are the investing activities. If we purchase any fixed asset, then it is an investing activity. If we purchase any investment, that is also a investing activity. Interest received thereon, dividend received thereon, that is also an investing activity. Now cash flow from financing activity, like repayment of loan. If any loan taken, that is the financing activity. Interest paid thereon, dividend paid, all these are financing activity. After making all this, we will get the net cash flow from operating, investing and financing. There is one adjustment also, like if OD is there, bank OD is there, which is of temporary nature, then that is cash and cash equivalent, which we will discuss later. And if any foreign currency, if any foreign transaction is there, foreign currency transaction related to, means due to the rate, due to the closing rate, any profit or gain arises, that is the adjustment entry which we will do here after opening cash and cash equivalent. Then there comes the closing cash and cash equivalent. So this is the cash flow by doing indirect method. Now comes the meaning of cash and cash equivalent. Cash means actual cash, liquid, which is easily which is in liquid form. Regular cash and cash balance, bank balance in current account, wherever it is, in India or outside India, in liquid form. Means cash means regular cash and bank balance in current account in India and outside India in liquid form. Cash equivalent means, cash equivalent is what? Cash equivalent, there we will check the nature of cash equivalent. What kind of, which is very highly liquid, that is cash equivalent. Which is highly liquid, easily convertible to cash, capable of being converted into known or determinable amount of cash. That means, you know, what is the value you get from your investment, what value you get from your investment. So very short term investment, that is cash and cash equivalent, means the period of that investment is 3 months from the date of making investment. So very short term investment means investment on deposit which mature within 3 months from the date of making investment or deposit, not within 3 months from the balance sheet. This will be explained by example. Suppose the date of making investment is 1st January 2022. The date of making investment or deposit is 1st January 2022. And the balance sheet date is 31st March 2022. And the date of maturity of that investment is suppose 30th April 2022. Now, what we will see, whether it is a cash or cash equivalent, how we will check? We will check from the date of balance sheet date or from the date of making investment. From the date of making investment, that is from Jan, Feb, March. It will 3 months. It will mature on April. So it will over the 3 months, means it is a period of 4 months for maturity. So it is not a cash equivalent. We will check from the date of making the investment. From the date of making investment, we will check the date, not from the date of balance sheet. But for the current asset purpose, it will be taken as a current asset, but it will not taken as a cash and cash. This example is taken as current asset, which will realize within 1 year. But for taking cash and cash equivalent, because it is prepared in January and it's mature in April, so it will almost take 4 months to mature. So this is not a cash and cash equivalent. Very short term item means investment or deposit which mature within 3 months from the date of making investment. From the date of making investment, not from the date of balance sheet. So this is the cash equivalent, which is very highly liquid, means easily convertible into cash and capable of being converted into known or determinable amount of cash. Means which is capable of being converted or known amount of cash. That means you know what is the value you will get for your investment. Means whatever you investing, you know what you will get at the time of conversion. We will not take the equity share because equity share is very volatile. It depends on totally on market. So equity share cannot be considered as cash and cash equivalent because of its volatile nature, because it is totally depend on market and very fluctuating. So we will not consider equity share for cash and cash equivalents. For example, if we made cash and cash equivalents, some of the examples we are taking, what we will take for cash and cash equivalents, if the investments is made in the form of bond, in the preference share, in the debentures, in the deposits, or such similar item, which fulfill the above three conditions, then only they are considered as a cash and cash equivalent. What are the conditions? Very short term investments, highly liquid and capable of being converted into determinable amount of cash. Now comes open-ended investment in mutual fund. Open-ended means what? Which you will easily exit and enter. In which option you will easily enter and exit. That mutual fund is known as open-ended investments, means that investment in which you will easily enter and you will take exit from that investment easily without any, like debt oriented mutual fund, or very short term short lifespan of mutual fund, that is take 90 days, which is convertible into cash, like treasury management. 90 days means very short term lifespan of mutual fund, for taking the example 90 days, and which is easily convertible into cash, like treasury management. So open ended investment is that investment in which you will easily take entry or exit. Debt oriented mutual fund is also an open ended, very short time lifespan of mutual fund, like 90 days, and which is easily convertible into cash, like treasury management fund. Open ended fund does not have any maturity period, means anytime you can enter, anytime you can exit. There's no such period fixed for the open ended mutual fund. You can take entry anytime, you can exit, you can take entry anytime, or you can take exit from that option at any time. Like you will take entry anytime, and you will take exit from take within 2 months, 3 months, 4 months, 6 months, 1 year. It depend on the investor. So its maturity depend on the investor. Whenever investment, whenever investor want to convert this mutual fund into cash or redeem at the, means its maturity is totally depend on the investor. Whether whenever the investor wants to convert this mutual fund into cash, it's totally decision of the investor. So redemption is based on the investor. Redemption of the option is based on the investor. If the company invest, suppose if the company wants to, there are two types of open-ended. Open-ended. First is if the company wants to park its money for a temporary period. For a temporary period, just to park its money, then that kind of investment is known as cash and cash equivalent. That the investment which is for a period which is less than 3 months, and which is very highly liquid, and certainable amount of is determinable, then that is all, that investment is cash and cash equivalent. Just the company wants to park its money for a temporary period, means classification of cash and cash equivalent depend on the intent of the entity, what the entity wants. If the entity has intention to realize the investment within 3 months, subject to the fulfillment of all the conditions, then only it is treated as cash and cash equivalent. Otherwise, if the conditions are not fulfilled, then it will treat investment under non-current asset. It is not treated as cash and cash equivalent. So for open-ended investment in mutual fund, all the conditions are satisfied. If it is parked, if the company wants to park its money for a temporary period, and it's subject to the fulfillment of all the three conditions of cash and cash equivalent, then only it is treated as a cash and cash equivalent. Otherwise, will be treated as investment. Bank or overdraft. What do you mean by bank overdraft? Bank overdraft is a cash credit. Is a cash credit given by the banker to the company. Why? In order to run their day-to-day activity, then that is the bank OD limit is. This guidance is not there in AS3, means a bank overdraft guidance is not there in AS3, it is specifically in Ind AS 7 only. So that is the major minor changes which we have said, that no such difference in AS3 and Ind AS 7, only some of the major changes are there which we will discuss. Bank overdraft is that change. This guidance is not available in AS3, specifically it is mentioned in Ind AS 7. So there are two types of bank overdraft. Like for a bank overdraft which is made for the cash management activity of the company, which is the part of the cash management activity of the company, that is for temporary basis. The OD which is made for a temporary basis in order to manage the cash activity of the company. These are of two nature. The nature of this type of cash management activity is of two types, which is treated as cash and cash equivalent. Only for the purpose of cash flow, this is treated as cash and cash equivalent only for the purpose of cash flow. Bank OD, that is for the cash management activity, that is of temporary nature, is treated as cash and cash equivalent only for the purpose of cash flow, but in balance sheet it will treated under, or it is shown under, current liability. For cash flow only, bank OD is treated as cash and cash equivalent, which is of nature of, which is of temporary basis, or which is of nature of cash management activity. If the bank OD is of other activity other than this two, it will be treated as financing activity in cash flow and shown under balance sheet as current liability. So bank OD in case where, means if the company has a seasonal income, suppose they are making income during the first 6 months and last 6 months the company is off, and that in during that off season the company need money to run its business, to pay off their dues, to pay off their liabilities. So that time the company tied a knot with the bank that yeah, bank, please help me during the my off season period. I will pay off all your dues during my seasonal period. So that time the overdraft which the company has made with the bank, in order to cover up its expenses, that kind of overdraft which is for a temporary period, that is known as the, that kind of overdraft is treated as cash and cash equivalent. Like bank OD in case where season is off and the cash is negative, that time company will take credit from the bank in order to pay off its expense on temporary basis, and when the season is on peak, the company pay off its dues to the bank. So that kind of nature of bank ODs is treated as cash and cash equivalent only for the purpose of cash flow, but it will be treated as, but it is shown in the balance sheet under current liability. Any overdraft in order to protect the reputation of the company, means if the company has current account, they had issued check and look, bank, you have to clear my check in whatever situation there may be. If the my balance bank balance will be negative, in that case also you will not dishonor my check. It will all about the reputation of the company, so you have to clear my issued check. So that kind of overdraft is also of temporary nature and also a part of cash and cash equivalent. So overdraft in order to protect the reputation of the company, like in if the check is issued in case there is insufficient fund in the bank of the company, so in that bank will not dishonor the check issued by the company in order to protect the reputation of the company. That kind of overdraft is of temporary nature and it will be treated as cash and cash equivalent. But in balance sheet, it will shown under current liability. And overdraft used for financing activity. Any overdraft means any loan taken for financing activity like purchase of any asset, and that kind of activity is treated as financing activities which is throughout the year stand withdrawn. Now foreign currency cash. If any currency is present in company's balance sheet, if any bank balance, if company has any bank balance in foreign currency, or if any amount of cash is present in dollar, that is also cash for the company, but in dollar, pound or any other currencies, that we will convert into closing rate as per AS 11 and Ind AS 21. What AS 11 and 21 says, all monetary item that have recorded, all have to record it at the closing rate. All the monetary item which are in foreign currency, all have to record it at a closing rate, closing foreign currency rate. Monetary item means which is readily convertible into cash or in the form of cash. Any forex gain or loss arises due to change in closing rate is charged to PL and not it is non-cash item removed. In case gain from operating activity, that we will remove because it is not from operation, it is due to the change in currency rate. That's why we will remove non-cash items from the operating activity and we will adjust that item in cash and opening cash and cash equivalent as forex gain unrealized on forex bank balance. That is not the actual realization, that is due to the change in rate. So deposit in foreign currency item interest. If we had made deposits in foreign currency item and received some interest in foreign currency, that income is our, the interest income is our investing activity. That is from investing activity. But the change due to the closing rate, the fluctuation rate due to conversion of rates, that is our foreign forex gain and loss, that we will adjust with the unrealized foreign forex gain and loss, that we will adjust with the cash, that is non-cash item. Now employee stock option. What is ESOP? If the company offer any stock option to its employee, if the employee serve to that company for 2 or 3 years, then the company will pay to that employee some part of the shares of the company. So that is the ESOP, that is the employee stock option. Company offer to employee stock option if the employee work with that company for 2 or 3 years. At the end of vesting period, means at the end of the vesting period, company will give some shares to its employee, that is called ESOP. So at the beginning of the period, company has to estimate whether the employee is there in the company for 2 to 3 years and then make provisions for ESOP to issue shares at that vesting period, which they will calculate at the fair value at the grant date of the, and has to calculate in the form of expense over the, and they will charge in the form of expense over the vesting period. At the end of the vesting period, the option get vested to the employee. That is the right of the employee to get vest that option. And it's depend on the employee's decision whether he will vest or not. Their right is there, but also it's depend on the employee's decision whether he will vest that option or not. And then employee can exercise. So at the time of issue of the ESOP, at the time of issue of employee stock option, there is no cash transaction. The company's cash flow is not impacted. It will not affect. It is affecting the capital structure. It is affecting the capital structure. It is affecting the reserve of the company. But there is no cash flow at that time, at the time of issue of ESOP. That's why it is a non-cash item. But at the time of excise, these are affecting the cash flow of the company, because at the time of issue, the company has issued the share, but it is not vested on the employee. But at the time of excising, it will be vested on the employee, and the employee will pay some money to the company for the exercise of the option. But after the vesting period, if the employee thinks that he will exercise the option, then there is a cash flow transaction, and that transaction comes under financing act. That's why that transaction will come under financing activity. But the shares issue of employee stock option is a non-cash transaction. But exercise of the ESOP is a financing activity. Some of the examples we will discuss, which activity comes under which head, like receipt from sale of operation. Obviously, it is an operating activity. Purchase of goods, it is an operating activity. Employees expenses, which is from operation, which is done for operation, it is also an operating activity. Advertisement expenses, it is also an operating activity. Provision for written down of inventory. If there is an obsolescence of inventory, it will not affect the cash of the company. There is no such cash item transaction. It will just the obsolescence of the company. So it is a non-cash item. Payment to supplier, it is an operating activity. Depreciation on fixed asset, no cash transaction is there. It is a non-cash item. Interest paid on cash credit means interest paid on bank OD. So it is if we pay any interest on loan taken, it is a financing activity. Advance received from customer, it is an operating activity. Any tax paid related to business operation means any tax paid relating to business, it is an operating activity. If we purchase 100% shares in subsidiary due to business combination, if we purchase 100% shares of the subsidiary, then we pay some purchase consideration. So that is our investing activity. We are investing some money on some business. That is our investing activity. If we are paying any purchase consideration. Issue of employee stock option, no cash transaction is there. Car purchase during the year, we are paying something in order to purchase an asset. It is an investing activity. Provident fund paid for the employees, that is an operating activity. Issuing of preference shares, that is a financing activity. Bonus shares issued, if the company is issuing any bonus share, there is no such cash transaction, but it affects the capital structure of the company. There is no cash transaction, but it affects the capital structure of the company. Purchase of license is an investing. If you are purchasing if we are purchasing any license is a kind of asset for the company, so it's an investing activity. Royalty received, suppose if any person has made any new item which is a totally new, which nobody has prepared that, and that he had sell to some other person, yeah, I have prepared, you will use this, and for that he are getting royalty, that is from operating activity. Rent received from letting out building, if you are given any building on rent and you are receiving any rent, some of the means for these transactions are depend on the nature of the business, what kind of nature you are running. In general, rent received is from building is an investing activity. If the person's business is another, and he has 2 3 buildings which he has given on rent, then it is that is for investment purpose, and he receive rent, that is an investing act. But the main operating activity is means real estate business. If he is doing real estate business and he is giving property on rent, then that is from operating activity. Suppose the business or bank is doing some deposits, receiving interest, that is, we will look in another way. But in general, what we considered, what activity we considered, we are discussing on. Bank, from bank perspective, it is totally different. Which activity is under which head? Like purchase of goodwill is an investing activity. Acquiring the asset of the company by issuing equity share, because equity share is a volatile in nature, it's non-cash transaction, there is no such non-cash transaction. Interim dividend paid, that is a financing activity, if the company has paid any interim dividend. And if the company dissolve and receive the amount in final settlement, then it is an investing activity. So if you like my channel, please subscribe. Thanking you for watching my video.